Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the 100 years of the United States dollar.
Hello everyone, my name is Radovan Vojtko and I'm CEO and Head of Research in Quantpedia. Today's topic will be US dollar. US dollar is a controversial topic. There are a lot of YouTube videos and articles about US dollar, a lot of conspiracies and a lot of horseshit articles written about this topic. But we are quants. Let's take a look on US dollar from the quantitative perspective. Let's take a look on some data and let's review how we can use the information about the price of the US dollar, about the performance of the US dollar in our trading. So firstly, I would like to show you the chart that you probably saw somewhere around the internet. So it's the purchasing power of the US dollar over the time. Yeah, it's true. As we can see, the purchasing power of one US dollar is steadily going down over the years. So 100 years ago, you were able to buy more stuff and more things for one US dollar. That's nothing new. It's called inflation. Of course, inflation is here since Roman Empire, so it's here for 1,000 of years, and it's not a problem only for US dollar, it's a problem for all of the other currencies. So it's not such important what is the inflation rate and what is the declining purchasing power of US dollar. What is more important is how does the US dollar stand against the other currencies, of course. And for something like that, we built US dollar factor price history over the last 100 years. We were interested to see what is the exchange rate of US dollar against the other currencies over the last 100 years. We used multiple different sources from the books, from public databases, etc., and we put them together. So dollar factor from 1926 until 1953 from a book that were obtained from Swedish Central Bank. Then there was a data set from 1953 until 1971 from BYS.org, which is Bank for International Settlement. And from 1971 until 2022, it's Quantpedia US dollar index. So we got all of those three data sets. We transformed monthly data into daily data. We did interpolation and we combined various data sources. So that's the result. So that's the performance of the US dollar against other currencies. So what we can see when we take a look on this chart is that, from the perspective of the comparing US dollar to other currencies, the US dollar is not so bad. So it means there are other currencies that are much worse than the US dollar. So overall, over 100 years, the US dollar appreciated against the other currencies. The strongest appreciation was, of course, during the World War II or after the Second World War in the 70s or 80s, at the end of the 90s, and of course during the recent times, especially in the recent situation, high inflation. Inflation in the US is high, but it's much lower than in other countries. So that's how the US dollar look like compared to other currencies. So what is the exchange rate of the US dollar against other currencies? And then we try to use performance and we try to evaluate what is the long-term performance of equities, bonds, and commodities relative to the strength of the US dollar. So what does it mean? We were checking for trends in US dollar strength, and we were looking if it can be used as predictor for timing other assets, so equities, bonds, or commodities. So here we have a chart. Of course, the performance of the other assets is much better than US dollar. So US 10-year bonds, US equities, and commodities, you can earn a lot of more money than just having the money parked in US dollar. So that's the reason why we invest and why we do not let our money sit somewhere in a bank. But the question is, can we use this chart and the information about the strength of the US dollar to time other financial markets? There are some hypotheses that we try to test. The first one was that during the times of the global economy strength, so there is a reduced holdings in US treasuries. When the dollar declines, US treasuries declines also. And US yields rise. So the strong dollar should signal the strong US treasury. So that's the first. The second hypothesis is that as the value of the US dollar rises, the US stock market index tend to rise along with it. And of course, the third hypothesis, strong dollar means weaker commodity prices. That's basically the logical hypothesis, as most of the commodities are priced in US dollars. These are the hypotheses from the academic research. What are the results? We calculated a moving average short and long-term moving average of the US dollar. The long-term average is we checked if the US dollar price is over 12-month moving average or under the 12-month moving average, and the short-term trend is US dollar over the 3-month average or under the 3-month average. So we always calculated those averages on the US dollar, and then we checked what is the performance of the other assets. So if we are over the US dollar moving average, what is the performance of the treasuries? So here are the results in the tables. So what we can see for the treasuries, there is notable advantage for the exposure in fixed income if the US dollar is over the 3-month average. So if the US dollar is strong, the treasuries have 4% performance or yearly performance, and if the US dollar is weak, the treasuries have just 2.45% performance. So that's after the Bretton Woods ends. Over the 100 years, so over the whole 100 years over which we have data, there is still some difference, but not so big than after 1971. Why we split the data set into before the Bretton Woods, after the Bretton Woods? Of course, after the Bretton Woods, the currencies can move against each other more freely. It can be also seen on the chart. So after 1971, there is significantly more volatility on currency markets compared to the time before the Bretton Woods. So that's the reason why we split this analysis. The first hypothesis, we can say that it's partly true, is not very strong. The strong US dollar means there will be probably stronger US treasuries in the future. Now, what is the impact of the US dollar on US equities? The results are really mixed. Sometimes they perform better. Sometimes they perform worse when the US dollar is strong or weak. So I would say when we take a better look on the tables, pattern is inconsistent over the whole sample. We do not feel it's very wise to make some strong theories based on the data alone. So US dollar doesn't have a very strong impact on equity prices. And what about the commodities? Judging from the data alone, we can observe that the commodities are performing significantly better when the US dollar is weak. So when the US dollar is under a 3-month moving average, for example, after the Bretton Woods, the commodities have over 9% performance. When the US dollar is strong, so is over 300-month moving average, the commodities will not perform very well. That's really true. However, the charts show that the impact was reversed in the first half of the sample, so before the Bretton Woods and during the Bretton Woods system. So the stronger dollar was followed by higher commodity prices. So it works now. The stronger dollar means lower commodity prices, but only works after the 1971. And then we created 2 spread portfolios. The first spread portfolio is long equities and short commodities. There is nothing extremely special in this portfolio. Then we build the second portfolio. The second is short treasuries and long commodities. We can see from the previous pictures that US dollar has a stronger impact on US treasuries, and it also has very strong impact on commodities. So when we build spread portfolio where we go long commodities and short treasuries, there are really significant spread performance. So when the US dollar is weak, there is very strong performance in this spread portfolio, and when US dollar is strong, there is significantly negative performance. So when we combine the US treasuries and commodities into one spread portfolio and we use the US dollar as a market timing signal, there's really interesting predictive power. That's our conclusion. So very, very quickly to conclude, US dollar has a significant predictive power on the commodities, and it has some predictive power on US treasuries, but I would say it doesn't have very strong predictive powers on equities. Thank you for your attention. Feel free to review the articles, and we will meet again in the next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.